This video is for entertainment purposes only. Today we're going to talk about how to avoid stock market crash by using 5 ETFs. The first one we reviewed in this series was the SPY ETF. Today I'm going to review the XLK to know exactly how to spot a coming stock market crash, how to avoid it, and when to get back in. The stock market crash, of course, that's coming is caused by COVID and also a new presidency under Joe Biden with new policies and of the recovery from all the stimulus spending. Unfortunately, these stock market crashes do happen at regular times throughout history. We've seen ones in the more recent past from 1987 to 2001 to 2008. And I also want to show you how you would have known that the 2020 stock market pullback when COVID first appeared was only temporary, so you could have stayed into your investments and reaped those big profits as it returned to greater heights than ever before. I'm Lynn Pearson with 60 Perfect, and thank you for being here today. We help you to get that money flowing, so please subscribe, hit the bell, and give this video a like if you're excited about learning how to avoid stock market crashes. So this is a great strategy using the XLK when you're in your 40s, 50s, or 60s. When you're younger, it makes more sense to keep putting money in index fund like ETF and be able to buy it during a stock market crash because those shares will be on sale and they'll go up over time eventually, and you'll be able to reap greater profits. When we're in our 40s, 50s, or 60s, we get much more nervous about a stock market crash that could last for 5 years, 10 years, or longer. So again, I'm going to show you how to avoid that. And during this series, I'll take you into those 5 ETFs. Today, we're going to look at the XLK. It's a great ETF to invest in if you don't have the time to sit there and track the stock market's ups or downs on a daily basis, because it has trended up over time, and I'll show that to you today too. So before we go into my computer, when I'll take you through the XLK, it's an excellent ETF for the strategy because it is a broad market index fund. Also, the XLK is one of the best volumes for any stock or ETF on the stock market. This means that you can easily trade in and out during a stock market crash. The XLK made wide price swings over time, enabling outsized profits. So let's go into my computer and I'll show you how to avoid stock market crashes. Okay, so here we are looking at the XLK ETF overview. I'm going to take you through a 60-second overview of the XLK ETF to help you be more familiar with it so that you understand I can help you spot and avoid stock market crashes. So first of all, the XLK is a technology sector spider fund. And when you own that, you get a dividend yield of 0.92%. This is as of January 21st, 2021. And also, the expense ratio is a mere 0.13%, so that's really low. And then to see the holdings, you can see here that the holdings include Apple, Microsoft, Visa, NVIDIA, MasterCard, PayPal, Adobe, Intel Corp, Salesforce, and Cisco. So those are the major holdings. Of course, it holds many more than just these funds. Let's go into E-Trade, and I'll show you how to spot stock market crashes. So here we are in E-Trade, and you want to make sure when you're looking for a stock market crash or following a long-term investing period to be looking at it in the weekly view, because otherwise the daily view is really choppy and it's hard to follow a consistent trend. The other thing I do is I make sure and select the Heikin-Ashi candlesticks. So the Heikin-Ashi candlesticks were an excellent invention by the Japanese, and what they've done is they've come up with a type of complex arithmetic that will enable the candlesticks to show more consistently upwards and downward trends. So when Heikin-Ashi is displaying, you'll see more green candlesticks together and more red candlesticks together. I have a whole video I've done on Heikin-Ashi, so when you're done here. So when you're done here, I really suggest you go visit that. I will have it linked in the description below. And the other 3 things you want to do is you want to look at the studies. You want to look at it with 3 moving averages you want to set up. So the 100-day moving average, a 25-day moving average, and a 50-day moving average. And you can see when you set them up, you put a period, which is 100-day for this one, exponential for the type, and then you can pick your color. What I look for to spot a major stock market crash is the 25-day moving average must cross over the 50-day moving average and the 100-day moving average. Then you know you have a longer-term correction on your hands. Because that did not happen in 2020, early 2020, the 25-day moving average didn't cross over anything. It was a real quick pullback. It would have enabled you to stay in this investment. And if you've been in XLK for quite a period of time, you'll see it's trended up beautifully. We'll kind of zoom out a little bit and show you over time. We can look at it in the month view too. And it shows you how it has trended up so consistently over the years and would have made you some really good money. So now we're going to go back to the weekly time view, and we're going to show you how to spot those stock market crashes. So you can see here the 25-day moving average only crossed over the 50-day moving average very briefly in 2018. So you would have stayed in your investment then. Same here, just kind of lightly touched it in 2016. And then it's been really consistent all the way through 2012. You go all the way back to 2008 when we had that major stock market crash, one of the two that I mentioned. And right here in February of 2008, the 25-day moving average crossed over the 50-day moving average, but it just tapped the 100-day moving average. So you wouldn't have gotten out yet until here when it crossed over the 100-day moving average at right around $22. You would have gotten out of XLK, and then you would have gotten back in when the Heikinashi candlesticks, the green candlesticks, cross above the 100-day moving average. So you've gotten back in right around $19. So protected yourself from that big crash, which lasted quite a while. You could have put your money invested somewhere else during that period of time. And then if we go all the way back now, you can see that it tapped it, but didn't cross over the 100-day moving average here in 2006. Here it did cross over both in 2005. So we've gotten out of that for a brief period. So the big stock market crash here was in 2000. This is the one everyone wanted to avoid, where the 25-day moving average crossed over the 50-day moving average and then over the 100-day moving average. This was a deep, long stock market crash. You would have gotten out of this ETF at around $38 per share, and you would have stayed out of it from here in late 2000 all the way through to where the green candlesticks popped above the 100-day moving average in 2003. So it would have kept you out of that for quite a long period of time, which would have been nice for that fund. This is also a good one, but you can see it's not as consistent as QQQ. QQQ is a better long-term investment because it doesn't have all this choppiness going back and forth where it was breaking past the 50-day moving average and the 100-day moving average. But what you do look for is, I want to make sure and that you know that you only get out of when the 25-day moving average crosses over the 50-day moving average and the 100-day moving average when there's red candlesticks showing. And then you get back in when there's green candlesticks showing. And then you would have stayed back in here again when it crossed below both of them. But here, when it crossed below them, it was during the time when it was starting to recover. You had a green candlestick, so you wouldn't have gotten out of it in 2006. It's still more choppy than QQQ and SPY, but been a pretty consistent investment overall. So that's your review for the XLK ETF related to stock market crashes as a potential investment, and how it compares to the SPDR ETF and the QQQ ETF. If you haven't yet, please subscribe, give this video a like, and ring that bell so you get notified about the rest of this stock market protection series. And I look forward to seeing you in the next video. Bye.